What is arbitrage in commodity spreads explained? Imagine spotting a price gap between two related commodities or contracts and turning it into a quick profit. That's the core idea behind arbitrage in commodity spreads. It's a way traders take advantage of differences in prices between related contracts or markets. Instead of betting on the overall price of a commodity going up or down, they focus on the spread, which is the difference in prices. Let's start with the basics. A commodity spread is simply the difference in price between two related contracts. These can be contracts for the same commodity but with different delivery dates, called calendar spreads. They can also be contracts for the same commodity in different locations, known as spatial spreads. Or they could involve two related commodities, like crude oil and heating oil, called intercommodity spreads. Sometimes, traders even look at three commodities at once in a more complex setup called triangular arbitrage. Arbitrage in this context means buying one contract and selling another at the same time to lock in a profit from the difference. The goal is to profit when the spread widens or narrows, depending on the trade. For example, if the price difference between a near-month crude oil contract and a later-month contract is larger than usual, a trader might buy the cheaper one and sell the more expensive one. When the spread returns to its normal level, they close both positions for a profit. One common type is calendar spread arbitrage. Here, traders buy a futures contract for a commodity that expires soon and sell a futures contract for the same commodity with a later expiration date. If the difference between these two contracts is bigger or smaller than usual, they can profit from the convergence of the spread over time. This is similar to cash and carry arbitrage, where storage costs and other factors are considered. Spatial arbitrage takes advantage of price differences in different locations. If gold is cheaper in one city than another, a trader can buy in the cheaper market and sell in the more expensive one, after accounting for transportation and transaction costs. This helps balance prices across regions. Intercommodity arbitrage involves trading spreads between two related commodities. For example, if the price of crude oil and heating oil are not aligned based on their historical relationship, traders can buy one and sell the other to profit from the mispricing. They look for patterns or fundamental reasons that suggest the spread will change. Triangular arbitrage is more complex. It involves three commodities or markets where the trader takes simultaneous positions to exploit pricing inefficiencies among all three. This requires careful analysis and quick execution. The key to all these strategies is that trades are usually done at the same time or very close together. This minimizes market risk because the profit depends on the spread changing, not the overall price of the commodity. It's a way to make profits with less exposure to the commodity's price swings. In practice, arbitrage in commodity spreads helps keep markets efficient. It corrects price differences caused by supply and demand imbalances, transportation costs, or market sentiment. Producers and consumers also use spread arbitrage to hedge risks across different delivery periods or locations. Investors use it to seek steady, low-risk returns by betting on predictable changes in spreads. So, in simple terms, arbitrage in commodity spreads is about spotting price differences between related contracts or markets and acting quickly to lock in profits. It's a smart way to trade that relies on understanding how prices relate across time, space, and related commodities. This approach helps keep markets balanced and offers opportunities for traders to earn from small but consistent price gaps.